Have you ever wondered how a central bank, like the Federal Reserve in the United States, guides the vast ship of the national economy? It is a complex dance, but at its heart are several powerful levers. Today, we are going to explore one of those key levers, a tool that might seem obscure but plays a crucial role in shaping our financial landscape. The discount rate is the interest rate at which commercial banks can borrow money directly from the central bank. This rate is a fundamental component of monetary policy because it directly influences the cost of funds for banks, which then impacts their ability and willingness to lend money to businesses and consumers throughout the economy. The core mechanism here lies in the cost of borrowing for banks. When the central bank lowers the discount rate, it essentially makes it cheaper for commercial banks to acquire short-term funds. This reduced cost can encourage banks to borrow more from the central bank and, in turn, increase their lending to the public. More available credit at potentially lower interest rates stimulates economic activity, encouraging businesses to invest and expand, and consumers to spend. Conversely, if the central bank raises the discount rate, borrowing becomes more expensive for banks, which can lead to higher lending rates for customers, effectively slowing down economic growth to combat inflationary pressures. This direct link between the central bank's rate and the bank's cost of capital is a powerful way to manage the money supply. For the broader economy, a change in the discount rate translates into adjustments in various market interest rates, including those for mortgages, car loans, and business investments. When the discount rate goes down, banks might lower their prime lending rate, making it more attractive for you to take out a loan for a new home or for a business to fund a new project. The opposite occurs when the discount rate rises, tightening credit conditions and making borrowing more costly, which can cool an overheating economy. These adjustments cascade through the financial system, affecting decisions from individual households to large corporations. It is important to understand that the central bank acts as a lender of last resort for commercial banks. This means that in times of financial stress or unexpected liquidity needs, banks can turn to the central bank for funds at the discount window. The discount rate itself often serves as a signal about the central bank's overall stance on monetary policy. A decrease signals an intention to ease monetary conditions, while an increase signals a tightening. While it is one of several tools, including open market operations and reserve requirements, the discount rate's symbolic and direct impact on bank funding makes it a critical part of the central bank's toolkit for managing economic stability. Ultimately, the discount rate is a vital instrument for central banks to achieve their mandated goals of price stability and maximum sustainable employment. By skillfully adjusting this rate, they influence the overall availability and cost of credit in the economy, steering us towards a path of balanced economic growth and preventing financial disruptions. Understanding its role provides valuable insight into how monetary policy shapes our daily financial lives and the broader economic environment.